NIO's management team elaborated on some key strategic initiatives in the latest quarter that I think all NIO stock investors should know about. So in this video, I'm going to go through those latest comments from NIO's management and what it could mean for investors in this innovative electric battery company.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So one of the big developments is the tariffs on the battery electric vehicles from China going into Europe. And NIO's management team saying that it has affected their pricing strategy and also sales volumes in Europe. Because of the tariffs, their prices in Europe has gone up quite significantly. So the big thing to note here is that NIO's management team had options on how to respond to the tariffs. They could have chosen to keep the prices the same and just absorb the tariffs and accept lower profit margins, or they could have increased prices to match up with the higher tariffs and so to maintain their profit margin. And they chose to raise prices. And that's been a theme with NIO recently, is an increased focus on profitability. They recently hit that big inflection point of becoming cash flow positive, and they they reiterated their guidance of trying to be break even by 2026. And so these decisions match with that strategy of trying to be self-sustaining, profitable, and go through the next stage of the business after all of that aggressive investment and massive losses on the bottom line in the early years, to try and get to that transition period where they're actually, breaking even at least, and then generating some profit. So along those lines, they talked about the vehicle margin for the Onvo L60, and they said it's not very high. It's a positive gross margin, but in the single digits. For the year of 2025, as they ramp up production and capacity and the delivery volume, they expect that the Onvo brand, its vehicle margin will be around 10%. So just to give you some context, they are hoping to ramp this up to 10,000 units per month by December of this year. And then by March of next year, they're hoping to get this up to 20,000 units per month. And so at that scale, they expect they can achieve a vehicle margin around 10%. So keep that in mind. If they don't get up to that scale, then as an investor, you can expect the profit margin for that vehicle, for that brand, to be lower. Okay. And if they can get up to a higher scale, more than 20,000 units per month, then the margin might be a little bit higher than 10%. So it depends on units, because the more units they produce, the cost per unit is lower. And of course, you sell more units, you generate more profit through economies in scale. And that's what NIO is hoping for. So investors, this is the exciting part of the business to watch out for now, is these lower priced brands, the Onvo and then the Firefly coming out, because they're open to a broader market because of the lower price points. And you can really see the organic demand for these products. Is it going to be as high as so many NIO stock investors were anticipating, or is it going to be less than what management is forecasting here? That remains to be seen. It'll be interesting to look out for this. They also said that they have 2 family SUVs in the pipeline ready to launch into the market next year. And remember, SUVs are much more in demand than sedans. So it's great to see the company launching into the market the thing that customers want, and the prices, they say, will be highly competitive. So these are going to be attractive price points SUVs coming into the market next year in what seems like an ever increasing supply of electric vehicles. And the market is oversupplied and oversaturated already, but at least NIO's operating, its core market is the Chinese market, where electric vehicle sales are actually growing robustly, where, over 3 out of 10 vehicle purchases are electric vehicles in the Chinese market, compared to less than 8 out of 100 or less than 9 out of 100 in the United States are electric vehicle sales. So people in China, desire these SUVs much more than people in the US do. And it has a lot to do with pricing. The market in China, they're able to produce these electric vehicles at lower price point, which makes them more attractive compared to the United States, where the electric vehicles are on the more expensive side, approaching $40,000 and above in most cases. Continuing on the discussion about profit, the company says that for the NIO brand specifically, they expect to achieve a 20% vehicle margin in 2025. Now, that would be truly impressive. I think only Tesla has a gross margin approaching 20%. And so for NIO to hit 20% in 2025 would be really strong. They said that in the most recent quarter, their vehicle margins were around 12%. So they're not that far away from 20%. But that incremental level from here to there is going to be challenging. And especially with the subsidies, with the incentives in the Chinese market going away in 2025, it'll be interesting to see how that impacts NIO's sales. But if they hit that 20% margin in 2025, that will be impressive, because that'll put the company right up there with the leaders in electric vehicles in terms of the gross margin or vehicle margin. Then they go on to talk about the fourth quarter, and according to the guidance, they expect to continue the positive free cash flow, which they just hit in the most recent quarter, and they're now saying that they expect that to continue in the next quarter. And for the year of 2025, as they target to double their delivery volume, and also by controlling their funding and the pace quarter over quarter, they will continue a positive growth on our operating free cash flow. Wow, that's great to hear. Not only did they hit that inflection point in free cash flow in the third quarter, they say for the fourth quarter, it's also going to be positive free cash flow. And then in 2025, it's only going to grow from there. That's great to hear. Also great to hear is that they're going to double their delivery volumes from 2024. Double the number of vehicles delivered in 2024 from 2023. That would be excellent growth. Of course, that's going to be supported by the launch of the Envo brand and the potential launch of the Firefly brand and Firefly vehicles in the first half of 2025 next year. Still, to double your sales would be impressive because the market's not growing that fast. So that would be an increase in market share, a meaningful increase in market share for NIO. And of course, that's going to come at the expense of some of the competitors in the region. Primarily, US competitors, I think, are going to be pushed out a little bit more. They've already been losing market share in China. And I think next year, the market share losses for the US-based companies, car companies, are going to continue decreasing in favor of local brands like NIO. Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.